Hey traders, this is Rocky Horner, aka the Queen here at Baby Pips, and I want to talk to you about the 5 ways you are sabotaging your trading. Now, I'm not going to assume that you're having a problem with trading, but I'm probably going to assume that there are places that you'd like to improve your skills. And yes, some of you might be at a place where you're really frustrated with your trading and you don't know where to turn. And rather than talk to you about those generic things like you're using too much leverage, or you're not using a trading plan, or you're not disciplined, and all those very general and almost useless type tips, I'm going to talk to you about 5 very specific ways right now and give you some insight into what these are, and also maybe a little insight into how you can begin to tackle these problems. And I didn't pull these 4, there's actually a list of 14. I'm going to talk to you right now about the first 5. But I didn't come up with this list just out of thin air. This has come from looking at my own mistakes, reliving them by understanding how I made them and how I could fix them. I've literally traveled the world and taught either live, in person, or via webinars and seminars, thousands of students. So this is coming not only from my mistakes, but from students that I've trained and observed. And I'm just giving this to you all basically on a silver platter because I think it will really make a huge difference in your trading if you can begin to understand these concepts. And actually in a webinar this Wednesday, so yes, in about 48 hours, Wednesday, May 28 at 8 p.m., I'm going to put on this whole webinar getting into detail about these 5 ways you're sabotaging your trading. Now, at the bottom of this update here at Baby Pips, there is a link for signing up for my free newsletter, and you automatically get the invitation and the links for any of these special sessions that I do. So make sure you're signed up so I can get that link over to you. All right, so what are these 5 ways you're sabotaging your trading? And these aren't in a particular order because cumulatively they create havoc. One by one, we can tackle them. So this isn't necessarily an importance. I mean, what is important to one person may not be to another. It really depends on whether or not you identify with any one of these errors, okay, one of these mistakes. So the first one's not dissecting a pair. Now the cool thing is, because you're a member here at Baby Pips, because you check out the blog here, not even 3 weeks ago I did a full half-hour walkthrough on what it means to dissect a pair. But let's get into a current example right now, and that's in the euro versus US dollar. Now everybody knows that very soon we're going to have that June 5 ECB rate decision. Now the last meeting, May 8, is when we put in this high in the euro US dollar, knocking on the door of the 140 handle. And we made a high up just shy of 140, so there was plenty of selling pressure in front of the major psychological level, aka the handle, and we got sent lower. Now this wasn't just a price-based or technical exhaustion, although there's probably a lot of justification for saying that alone would have gotten our attention, right? But this had a lot to do with the timing of the economic calendar, which is so important for traders to understand, how important it is to understand when the economic calendar is indicating, hey, we're going to have a volatility event, and something like an ECB event can definitely be a needle mover. So we went up, created a high, which, by the way, I like to call this a rope-a-dope. Do you guys know what I mean by a rope-a-dope? This is basically the market fooling traders. I am sure, in fact, it's inevitable that traders bought up at these levels and got long in front of the 140 handle. Well, if it was the case of a pullback, and if it was the case of a trend, I would say that probably may not have been a terrible entry, but within the situation where we have chop, a 2 to 4 o'clock chop, and if you're following me here at Baby Pips for any length of time, you know exactly what I mean by a 2 to 4 o'clock chop. I mean, that's really what we're seeing in here. If you know what I'm talking about, then you know you're much more highly anticipating exhaustion at the highs. The market will fatigue up in those levels. So we're not only dealing with seasonal highs, by the way, on that Euro US, and we actually had a webinar not too long ago about seasonals. So these are things that indicated not just the underlying market trend, but dissecting the pair, understanding the story that was ruling the euro, in this case, Draghi's unexpected comments of talking about QE and things that were very surprising to euro bulls who are waiting for a breakout through the 140 level. This sent the euro down 400 pips, nearly 400 pips, about 350 if you look at current levels right now. Well, so what does that have to do with not dissecting a pair? Dissecting a pair means I just don't fall in love with the pair that is the Euro-US, but rather I understand the individual currency stories on both sides of the pair. And I teach you how to do that. I will get you into teaching how to do that on the webinar on Wednesday. Let's talk about the next one here, lack of harmony. Well, let's use the same example. If I am looking at the Euro-US dollar and I see that this pair got sent sharply lower, harmony means I understand what's happening to the US dollar here. Harmony can extend to relationships like the yen and risk. The euro and the US dollar have an inverse sympathetic relationship. So just when I know the euro is getting beat down lower, I know the dollar index story is going to become very bullish. Not because suddenly traders want to necessarily rally the dollar on its own accord, but rather the dollar looks very, very, at this point it was looking very, very oversold, but the reason it rallied was the euro as a driver. And this concept of understanding the driver of a pair, understanding the individual currency story, that all goes back to understanding, dissecting a pair. The harmony comes because, in this case, with the euro and US, weak euro means strong US. Where are you exposed? Where do you have trades that will not necessarily work as well with a strong US dollar? So that's where you have to think about the harmony. And a lot of times what I find new traders do, because they're not doing step number one, dissecting the pair, they fail to understand harmony, and they oftentimes inadvertently hedge themselves, especially when you think of the triangle of the euro, Swissy, and the greenback. So they oftentimes inadvertently hedge themselves, which, again, we're speculators. I'm not looking to hedge myself. If I want to protect risk, I'm not going to put on a hedge. Although sometimes, sure, an option can do that, but that's getting way advanced here. For the most part, I protect risk with what? A stop loss. Okay? Hedging really isn't a tool that serves speculators that well, even though we've been brainwashed to think it does. I just want you to rethink that and make sure you're not hedging yourself, and that goes to harmony. The clear individual currency story goes back to dissecting a pair. Once you've dissected a pair, you've really got to commit to a story. And one of the stories that I'm committing to right now is this idea that since Draghi has already sent the euro down nearly 400 pips, and it's now testing the 200 period simple moving average, which I call the SMAC, 200 period simple moving average on the close, the 200 SMAC. We've already been driven down to this level. Draghi's going to have to come out on June 5 and shock the bulls and reinvigorate the bears that much more to continue the move lower. There's going to have to be a bearish surprise, a surprise of fear, and to drive this thing lower. If not, I smell a short squeeze. I smell an overbought, oversold short squeeze, and I think that will trigger some buying. Now, that's an individual currency story. It's a story. It's not an individual currency fact. This is a scenario. That means I could also see exhaustion on the greenback, going back to the harmony story. So being able to figure out, all right, where's the individual currency story? What's a potential story for the currency, and how does that affect my euro US? How does that affect my US dollar pairs? How does that affect my euro pairs? Individual currency story. That one move in the euro could have widespread ramification. Now, one of the reasons this market is so tricky right now is the lack of directional bias. In other words, we don't have really nice trends across the pairs the way we used to. In fact, the last market that I basically phased out of, basically trailing stopped out of, was this nice trend that I enjoyed throughout much of 2014. A rally from about the 9,600 level up to about 103. Wonderful trend. I mean, fantastic trend. While it lasted. Now what's happened? On a lot of situations where we had 12 to 2 o'clock or 4 to 6 o'clock trends, we've transitioned into sideways markets, 2 to 4 markets. There are, you can see this over and over and over again, markets that are moving in sideways ranges. And I'm using this Aussie as an example because the Aussie was a strength story for much of the year, and now it has lost a lot of that swagger, and it's gone into a 2 to 4 o'clock chop. So while I don't want to aggressively sell Aussie, I really want to respect where we are within the scope of the chop. It's a lot easier to sell Aussie here above 94, and it's a lot easier to buy Aussie here around 92 and respect the sentiment shifts, the exhaustion, the price action exhaustion. So that's, again, another thing to think about in terms of one of the challenges, which is that lack of directional bias. We don't have a lot of trends. We have a handful of trends. Ones that come to mind are ones like the euro pound, perhaps the cable. They're very few and far between. And finding them goes back to dissecting the pair and finding an individual currency story. Number 5 is probably the most important, and that is this: point of validity versus pips. A lot of traders start counting pips, not only to the upside but to the downside, not only for profit but for loss. And that is an individual story. How many pips you're willing to wait, give back to the market, or let the market take from you is an individual tolerance. It's your own uncle point. It's your own pain threshold. How much heat you take or want to take is completely individual. How much heat, how much pain, how many pips, how many dollars you have to factor in to your trading plan is a completely different conversation. How much wiggle does a market ask you to give it? Where is the trend no longer valid? Where are the range limits exceeded, therefore nullifying a fade? Things of that nature are completely different, chart-based and price-based, not dollar-based, not pip-based, not pip-based completely, although we can talk about pip ranges, and we will. But they are actually decisions that must be made without considering initially a dollar amount. Okay? A lot of traders stop with a 1%, 2%, or a dollar amount, and those are very random. You want to factor in hourly and daily pip movement ranges based upon history. You want to factor in where the trend and your strategy is going to be valid. So use the strategy to tell you where you will get in or get out, not a number of pips or dollars or a percentage. Okay, those are far too generic. So point of validity versus pips, and we'll get into that a whole lot more on Wednesday. So I hope this has started a discussion that I look forward to picking up with you Wednesday evening, 8 o'clock. Yes, it will be recorded, and if you want the recording sent to you later on, be sure to sign up for my newsletter. I will be sending that out to those free newsletter subscribers after Wednesday, after the webinar is completed. So thanks as always for your time. If you have any questions or comments, leave them here at the blog. I check them out myself, and I will be happy to answer any questions that you have. And I hope to see you Wednesday. Until the next update, I'll see you.